Hello and welcome to another episode of Monday Macro View. This is Osama Rizvi coming to you from Primary Vision Network. There's a lot going on in the oil markets, and I want to see if my case or people who are still bearish on oil markets, if anything has changed in these past few days, and if there is a chance or there is a case to be made for a bullish oil market. It's always good to revisit your points of views. First of all, so just jumping right in, first of all, look at this technical analysis with the candles and all those things. I myself am not really a huge fan of these because they can change like this whenever there is a shift in sentiments and, of course, fundamentals as well. But they tend to show somehow what's happening, what's going to happen, what should we expect. So you can see there is a bias building towards the lower side, and the next point is 76, as you can see here. It's written as well. And if it is broken, it might head lower as well. So the question that will oil prices touch 100, look at this. People are now talking about it going below $80. And why is this happening? I've written in my weekly research articles from primaryvision.co. Mark has spoken about it, and we are trying to highlight that so there was a narrative going on. There was demand destruction and oil supply concerns. The narrative has the recent global economic indicators, the build-up of recessionary factors, the overall health of the global economy has tipped the narrative in the favor of a demand destruction, a demand reduction, if not a destruction. And this has been cemented recently, of course, by the OPEC Plus surprise cuts that have shown this this long-term thinking that really the demand might not be as strong as many people are, or many organizations are predicting it to be. So Clyde Russell, once again, he does this brilliant job in his columns for Reuters, where he, especially on Chinese refinery capacity, China's oil markets and input and output, exports and imports. And he has said that China continues to add to its inventories despite a record throughput in refinery capacity. So you see that China's refinery throughput touched an all-time high of 63.9, almost 64 million tons in March, which was about 15.11 million barrels per day. But at the same time, the amount of crude available to the domestic refiners also rose in March. So did the imports, and it was about 16.67 million barrels per day. Subtracting it from the domestic production and what was imported and what was refined, he has given a figure of about 1.56 million barrels per day that likely flowed into the commercial or strategic inventories. Now, that figure is, of course, greater than what we have seen previously going into the inventories. And this makes you question the whole narrative because according to many estimates, China is going to be responsible for half the global oil demand. And now this thing makes you think twice that whether China will register that sort of a demand or not. There's a lot of oil in the floating storage as well. So we don't know what's going to happen. The next chart shows this, what I've just told you, in a very good, a very neat chart. You see the total crude available going up more than the refinery runs. However, recently there has been an interesting news that China is rolling back its generous quotas, which was about 18 or 19 million tons, the allowances. Now China will limit them in the second batch, which would be announced somewhere in June, between 8 million tons to 12 million tons. So let's see what happens then, and how does that change the dynamics of China's imports and refining throughput. Furthermore, oil posted a loss. Oil prices fell more than 2%, if I'm not mistaken. Gasoline inventories jumped by 1.3 million barrels per day. The labor market, the number of Americans filing for unemployment raised a little bit, showing concerns that we also discussed previously, that the labor market might also show the slowdown that we can see in manufacturing sector and other retail sector. Implied gasoline demand also fell 3.9% year-on-year basis. But overall, what I mean to say is that there is a bearish sentiment holding on. You look at the oil loadings from Russian Western ports; it has risen to its highest level since 2019. So that's the case for oil. That's the bearish case for oil. Furthermore, there were also some interesting news in terms of Apple and India. I wrote a Substack on it as well. So you can see the share of Apple in India's smartphone market is very low at 3.54%. Gives a huge opportunity for India, for Apple to scale up its sales in the what would be now the most populous country in the world. India, however, is one of the lowest. It is one of the countries with the lowest per capita income in all the 26 countries that Apple has an outlet in. So that, but still, that represents a potential, a possibility. According to IDC, these are some very interesting smartphone statistics in terms of India, and where India posted registered a decline of in oil, a 10% decline in its smartphone sales, and finished the year 2022 at 144 million shipments. Finally, a look at the consumer market. You can see the consumer class of China is more than twice than that of the India, but this can also change, but it'll take a lot of other steps, moving pieces. But I thought it was very interesting what's happening in the global economy and what's happening especially in the Eastern Hemisphere, in the Asian continent, and how it is still relevant. It's becoming more relevant actually for companies in the US. Finally, we can't call it a day without discussing recession. Recession is nigh. Many people are thinking maybe this winter. We can't put a timeline on this, but of course, look at this. Many strategists are now saying that it won't come. It won't be very easy. So we're not looking for a soft landing. Also, what's interesting is that the Conference Board's leading economic index have fallen by 1.2% in March, which now it stands at its lowest point since November 2020. That's something. Moreover, another another recession indicator hit at its, I don't know, it's the highest since 1982. I couldn't do the quick math. So the recession index by New York Federal Bank Reserve Bank of New York, Federal Reserve Bank of New York, it is at 58%. Look at this chart, which shows the inverted yield curves. It continues to be inverted. This chart was made by a very good friend, Piero, and he has also written extensively on this topic. So we can't ignore these things. Recession, I've talked about in the previous episode as well. These indicators show that there is a recession on the way. Finally, the market sentiment tracker, you can see the bearish side overweighing the opposite, the recovery side. Export orders have fallen, import orders have fallen, the PMI is at low, house building index is low. Yellen's comment about China and other things, showing geopolitical tensions. All of it, I think the real economy will still be in trouble and chances of recession remains high. I'll see you all next week, and thank you so much for watching.